Hi, I'm Keith Knight,
Hi, I'm Jamie Knight.
and this is Nighttime.
Our kids are in bed, so we're here with you.
All right. So, in the last episode, we talked a little bit about why we invest in real estate. In this episode, we thought we'd go over a little bit of the financing aspect, right? So, most people, when they're getting into real estate as an investment class, are doing it in what would be considered residential, so 1 to 4 units. If you go above 4 units or 5 units and above, even if it's apartment complexes, etc., it's no longer considered residential in terms of financing or an investment class. It's considered commercial. And we'll talk about that maybe later on in our series. So we're talking residential financing. What are some of our options?
There are two common options. You have FHA and conventional. So the FHA option is attractive to first-time investors because it's as low as 3.5% down for your down payment. But with that, you have to carry something called private mortgage insurance, and that's because it's less than 20% down. And one more caveat with FHA is you have to have it as your primary residence, that dwelling, for at least 12 months.
Right. And depending on the bank or institution you're working with, sometimes it's more than 12 months. I've seen it as high as 24, but 12 months is pretty common. That's kind of like the industry standard. The other thing to remember with PMI, so PMI is not protecting you. It's private mortgage insurance. It covers the bank. So when you have anything less than 20% equity in a property, the bank sees that as a higher risk. And so they want you to pay for insurance that will cover them, their losses, if you lose the property. For whatever reason, something happens and you can't make payments and you bail, PMI will make them whole. So you're paying for it, but it's to cover their financial risk if you're to walk away from the property.
So it's important to include that when you're running numbers.
Right, exactly. So if we look at our escrow, basically you take your mortgage payment. So that's going to be your principal and your interest, your monthly payment for that. You roll in your monthly portion of your insurance for the property, so the actual building or dwelling insurance. PMI if you're less than 20% equity, and then taxes.
Right.
So that'll make up your monthly payment or your escrow payment for the property. And then that is what they use as a part of understanding your debt to income ratio. The whole idea with debt to income ratio, when you're doing your residential financing, so 1 to 4 units, they look at your ability to pay the bill. Their primary concern is, can you afford this, right? And so what they do is they have ratios for debt to income that they'll allow or loan against. And depending on how close you are to the maximum limit, it might actually impact the rate that you get in terms of your mortgage for your interest. So it's important to understand things like credit card debt or other recurring payments like a car payment, student loans. Those kinds of things are part of your debt load. And those are considered when you're going to buy a property. Local banks tend to be a little more flexible on what they can borrow there, whereas the national banks are pretty rigid in what that ratio will be.
Right.
So on a conventional loan, generally you can start as low as 5%. So just like we saw with the FHA, if you're not putting down 20% equity for your down payment, you'll still have to cover the PMI. Unlike the FHA loan, you can have more than one conventional loan at the same time. With FHA, you can only carry one mortgage at a time as FHA. Now, you can start with an FHA, refinance out, and then do another FHA application. Most banks will have a limit to how many conventional loans that you have. And when you reach that point, what you can start to look at is portfolio loans, free up your loan count, if you will, to continue to borrow against properties. So just like what we saw with the FHA loan, with a conventional loan, if you have less than 20% equity, so if you're going in with a minimum of 5%, you're still going to have PMI. So that's going to count as a part of your debt to income ratio when they're running the numbers. Also, you're going to have to live in the property for at least 12 months as your primary residence.
Yeah. So not 20% down, you gotta live there.
Right.
So that actually excludes vacation homes as your primary residence because those require at least 20% more coverage and they can only fall under conventional.
Vacation homes are like a secondary home that you're going to do a short-term format rental like Airbnb or VRBO is going to be requiring a minimum of 20% down. What we've experienced more often than not is a minimum of 25% down, but that's really going to depend on the lending institution that you're working with. When you start out, right, if you're doing a primary residence as a single unit, that's fine. A lot of people do it, but you have no additional cash flow until you move out of that property
Right.
and into another one, right? Well, in the case of a duplex, a triplex, or a quad, you actually have income. Either you inherit tenants, so day one, or shortly after you acquire the property, you're gonna, maybe you spruce it up, maybe fix it up a little bit, but you're gonna rent it out. You don't have to wait for 12 months to start generating cash flow. And here's the catch, right? Here's the rub. In that situation, we talked about our debt to income ratio, right? The banks will count up to 85%. Generally, it's like 70 to 85% of your expected rental income as a part of your debt to income ratio. All of a sudden,
Things got easier.
yeah, now you can qualify for a higher loan. So now you can start looking at bigger properties because you might be thinking, well, how am I going to afford a quadplex when, I'm doing this to make more money because I'm trying to generate wealth. I don't have wealth yet, right? Um, Part of that entry is still the down payment. So you're still going to have to come up with that. But oh, by the way, with FHA, it's 3.5%, which most people can manage. I mean, that could be a loan against your 401k. Maybe you're borrowing money from a relative. If you do that, you have to document it.
Yes.
Banks are going to be really strict on how that process goes.
They're going to watch you.
They are, but you can still do it that way.
Yeah.
So it's relatively low money to acquire the property. If you can get a triplex or a quadplex, that's great because then generally with those two options, even in today's real estate market, you're going to be cash flow positive as soon as you have all of the units rentals. So this is where the game starts to get a lot of fun because this is where you can start pulling pieces together. You're opening up options and oh, by the way, if you did FHA or conventional with 5% down, we'll say, you only have to live there for 12 months. So if you buy a, duplex, triplex, quadplex, 12 months later, you can move out and find another property that you can do that again. Yeah, we'll do another episode that talks about more of uh, how do you determine the deal is a good deal or something to walk away from? What's going to be something that is relatively maybe low risk, or what's something that's going to be low risk for you? And we'll talk about maybe some of your criteria for purchasing,
rental markets,
rental. Yeah,
locations.
there's a lot of different things that come into that. Some of it's personal, some of it's financial, some of it is convenience, right? Depending on where you are, like maybe you don't want to have a rental that's an hour away or 2 hours away or halfway across the country. Yeah, talk about that in another episode.
Yes.
Yeah. So that pretty much sums up, I think, what we wanted to talk about on this episode about the more traditional options for financing in the residential space. So again, FHA is an option, 3.5% down. Conventional starts at 5%. Anything less than 20% equity, you're going to have PMI.
And you got to live there.
And you got to live there for 12 months, sometimes more, but typically 12 months. And then the benefit of having multifamily real estate is that you can count a portion of that income, typically 70 to 85%, as a part of income you already have that goes towards your debt to income ratio.
It's all good.
All right. Well, that wraps it up for us tonight.
Thanks for joining us. Good night.
Good night.